Hello, hi. My name's Jerry Miller from Trendsignal, the trader education company. And this week's session, we're going to be looking at the week ahead and also what's happening the previous week. It's been an interesting time. Without further ado, let's have a look at the first bit of my presentation. Really, just looking at what's happened last week. We've had 2 weeks of risk on moves ahead of these key interest rate decisions this week, the week beginning of the 31st of October. Um, it's not actually just US interest rates that are on the move this week. We've also got the MPC here in the UK telling us what rate rises we're going to have to suffer this week as well. Last week was interesting for a lot of reasons, actually. When we talk about risk on, we talk about equities going up, the dollar generally heading lower, bond yields typically heading lower, but that's not always been the case, and commodities rising. And that's really what a risk on move is. A risk off move is the opposite, obviously. And really, what's been driving the markets over the last couple of weeks is the moves in equities. Really, they're sort of leading the charge. Um, but it's not been plain sailing, really. We're in the middle of the sort of third quarter earnings season. And last week, we had all the big tech stock results, that the FANGs, FAANG, that's Facebook, Apple, Amazon, Netflix, Google. Of course, Google's not called Google anymore, it's Alphabet. Um, but anyway, these companies did not have a particularly good week. In total, they lost a combined, in terms of effect on their own share price, they lost a combined value of 750 billion last week in market capitalization. It started earlier on last week with Alphabet and Microsoft, so Alphabet, that's Google, disappointed with weaker revenues, but the headline loser last week was definitely Meta, Meta being the owner of Facebook. Um, followed closely by Amazon, who also posted some very disappointing results last Thursday. Meta especially was particularly weak, where analysts highlighted the um, slower growth and increasing costs that its founder Mark Zuckerberg has been really heavily criticized for focusing on the metaverse and AI projects, whilst sort of almost neglecting where the bulk of the revenues come from. But over the week, Meta has had a torrid time. I think it lost a total of about 24% as investors really dumped the stock. Amazon was also in the wars on Thursday. Well, Thursday evening after hours, released its less than exciting results and gave some fairly downbeat forecasts for the run up to Christmas. And the stock was really sold off quite significantly. At one stage on Thursday evening last week, it was down about 19%. And basically what it said that Q4 revenues would be in the sort of zone between 140, 148 billion, which is about 15 billion less than most analysts had forecast. But despite the gloom, Apple came in, posted better than expected results, and actually had one of its best days for a couple of years. It was up 7.6% on the day on Friday, and I think that really set the tone for the rest of the market and emboldened investors, I guess, who pushed up equities um, to enable the markets, actually, the major indices, to close higher on the week, which was surprising given how poorly the tech sector was. Anyway, that was last week. Let's look what's happening this week. So let's just look at our next part of the presentation, expectations for UK and US interest rates. It's a big week for markets this week. We don't normally have the US Central Bank, that's the Federal Reserve, and its rate setting committee, the FOMC, meeting the same week as we have other key data release, being the non-farm employment change. And it's the really the rate decision I want to focus on. That is a key event anyway, but in a week where we've got non-farm payroll, it's got extra poignancy. It's the second to last meeting of the year. The Federal Reserve, people refer to them as their monthly policy meetings, but in fact they meet 8 times a year. I'm not sure what you'd refer to meetings 8 times a year, but we'll call them monthly meetings. And they're meeting this Wednesday. Wednesday, the 2nd of November. And the market is expecting a rise in interest rates despite some poor data, despite some better data. It sort of ebbs and flows, but the market is pretty much set on another 0.75% rate rise, and that'll be the fourth such rise over the past four meetings. Um, the CME have this thing called the Fed Watch tool, which tells us what the rates are going to be at these particular meetings. Let's have a quick look at that. Just one second. So I've opened up this site from the Chicago Mercantile Exchange, and it's basically what it does. It tells us what the Fed funds rate are going to be on the date of each meeting. And the one I've highlighted at the moment is the 2nd of November, and it shows you that there's pretty much an odds-on certainty. 88.7% expect rates to increase from 3 to 3.25% to 3.25%, 4%. There's been a little bit of a softening in rate expectations a week ago. There was 95% probability of 0.75% rate rise. I still think that's what we're expecting, and I know that's what we're expecting, and I think that's what the outcome will be. If we look at the final meeting of the year on the 14th of December, you can see that there's a split between 4.25 to 4.5 and 4.5 to 4.75. So what that basically means is um, there's a 50% probability for a 0.5% rate rise and 50% probability for a 0.75% rate rise. And that's sort of softened a little bit over the last week or so. A week ago, we were there was a 55% probability of a 0.75% rate rise. That's now drifted to 46%. So it's only marginal, but this is what the market tends to focus on, and that's how we can gauge as to what we're expecting from the Federal Reserve. But I think when this is released, there'll be a big reaction. The market tends to want to see what clues they can get from the FOMC statement, which is released at the same time, and then actually from the press conference, which is conducted by Jay Powell, the chairman of the Federal Reserve. So we're all about clues as to what future rate rises there will be. And there's a feeling in the markets that after the December rate rise, whether it be a 0.5 or 0.75%, there may be a bit of a pause in proceedings. Anyway, just be very careful. The markets are particularly sensitive to this event. The dollar, US and global equities, global bonds and commodities, all very sensitive to this release. And remember, because we've only got a 4-hour difference this week between the UK and the US, this data release is not at its customary 7 o'clock, it's at 6 o'clock. So just make sure you mark that down. Okay, let's have a look at the next final bit of the session. Before I do that, actually, I forgot about the Bank of England and our own Monetary Policy Committee are also meeting this week. So just highlighting on the screen here, we're expecting a rate rise, so that's the base rate, going up from 2.25% to 3%. Gosh, what's going on in the UK markets? It's been all over the place. Before the resignation of Truss as Prime Minister, I think markets were expecting the Bank of England to raise rates by as much as 1%. I think that now looks less likely. It's still a possibility, but I think it's certainly a lot less likely now. Economists have really dialed down their expectations for inflation now that that mini budget of Kwasi Kwarteng has been completely reversed. So we're expecting a 0.75% hike in rates to 3%. Governor Andrew Bailey, will be speaking at the press conference at 12:30 following the decision, which, again, like any of these press conferences, like the one after the FOMC meeting the night before, this is what we tend to focus on to find out any clues about future rate rises. But I think it's clear, listening to the ECB last week and probably the FOMC, that there's more rate rises to come after this week's rate rises. So the story continues. Okay, obviously Sterling, FTSE 100, FTSE 250 gilts, all very sensitive to this data release. Okay, let's have a look at the next bit of my presentation. So Non-farm employment data. This is a bit of a, I'm not saying it's an afterthought, but normally this data release would be particularly important. This is what the market focuses on, not just interest rates, but also employment data. And the reason being, in the United States, the Federal Reserve, that's the central bank for the United States, has got two mandates. First of all, the one is to maintain price stability, which is what all central banks have, but also a second mandate, which is to maintain full employment. Full employment, it's difficult to know exactly what full employment is because you always need a certain amount of slack in the system to allow people to migrate from one job to another. You get people leaving the workforce, joining the workforce. But I think at 3.6%, which is what it's expected to be, that's pretty full. And the data recently doesn't suggest that that is slackening much, and that's something that Fed watch particularly closely, and that's what drives their decision making in terms of their interest rate policy. Anyway, Friday, we are expecting another rise in jobs for October this time, 200,000 jobs with a decline, sorry, with a headline employment rate or unemployment rate of 3.6%. And I think normally this number has a big effect on the markets. But I just think after the FOMC meeting from the Wednesday, which the Fed will have knowledge of that data before they make their decision. I don't think that this data release will have as big an impact as it perhaps would have been if it was on its own this week, if you know what I mean. But of course, if there is a significantly better number than expected, a lot more than 200,000 new jobs, and the previous numbers was revised upwards, for example, then that really might worry the markets because it could suggest that the Fed will have to raise rates by another 0.75% in December meeting. So if it's sort of, I think it will be the reaction might be a little bit more muted than normal, but hey, we won't be able to replay both of those scenarios, will we? But anyway, the dollar, US equities are all very sensitive, and commodities very sensitive to that data release. So that's another one for the calendar. That's it. Thanks very much for listening.